So Robinhood just dropped earnings and the stock tanked about 7 to 8% after hours. And honestly, most of the headlines you're reading right now are getting the story wrong. Look, if you're short on time and you refuse to listen to a random guy on the internet with a cat avatar, here's your one takeaway. Robinhood is printing money, growing deposits at record pace, and expanding into banking. What spooked the market is a crypto revenue miss and a guidance that basically says we're spending big on a bunch of new bets. Whether that scares you or excites you depends entirely on your time horizon. And if you want to know the reason why, alright, now stick around because I'm going to walk you through every single line that matters. Oh, and by the way, I'm DataCat. I've been doing this for about 7 months now. Before this, I was an analyst inside a Fortune 50 company. You know, the kind of job where you make slides that executives nod at and then ignore. I traded that life for a ring light and a mechanical keyboard. Not exactly a glamorous upgrade, but hey, at least my cat respects my work now. Okay, that was clearly a lie. Well, no, actually he doesn't. He is basically staring at me now, asking why I'm not out working for his canned tuna. Anyway, this channel is still small, still growing, and I genuinely appreciate every single person who sticks around. No courses to sell, no premium Discord, none of that. Just me, a spreadsheet, and a cat who judges my financial opinions silently. So if you want more of this, if you find this kind of breakdown useful, a like and subscribe genuinely helps this channel show up for other people. Alright, let's get into it. So here's what went down. The street was expecting Q4 earnings per share of about 66 cents. Robinhood came in at 63 cents. Revenue, analysts had about $1.350 billion. Robinhood posted $1.280. So we're talking about a miss of 3 cents on earnings and roughly $70 million on revenue. Now, in a normal world, that's not catastrophic, but Robinhood, or the entire market, is not living in a normal world right now. This stock has been priced for what we call beat and raise. When you're priced for perfection and you just deliver pretty good, well, the market doesn't pat you on the back. It sells first and asks questions later. Kind of like a cat knocking a glass off the table. Swift, merciless, no remorse. But, and this is important, the miss alone doesn't tell you whether this business is actually weakening. You have to look underneath. And that's where things get more nuanced than the headlines suggest, right? Let me throw you some numbers that most coverage is glossing over. Platform assets hit $324 billion. That's up roughly 70% year over year. Net deposits were $68 billion, a record. Management reiterated they're targeting 20% plus net deposit growth in 2026. Now, I can't stress enough, but this is important, because deposits are the least cyclical part of this business. When people move their money in, they tend to keep it there. It signals trust, it signals stickiness. It's the foundation for everything else Robinhood wants to build. Full year 2025 revenue came in at $4.5 billion, up over 50% year over year. Adjusted EBITDA, up 76% at a 56% margin. And for context, they've maintained incremental adjusted EBITDA margins above 70% for 3 straight years. And that's some real strong operating leverage. That's management saying, we can grow without lighting money on fire. And in a market that has been burned by growth at all cost companies, that actually matters quite a bit. Now let's talk about the products that are quietly building recurring revenue. Robinhood Gold, their premium subscription, hit 4.2 million subscribers. That's up 58% year over year. The Gold Card has 600,000 customers with $10 billion in annualized spend. They're planning to push past 1 million cardholders by year end. And then there's banking. 25,000 plus funded accounts, over 400 million in balances, and on top of that, here's the stat that made me sit up. More than 50% of those funded banking customers have set up direct deposit. That direct deposit attach rate is a quality signal. When someone routes their paycheck through you, you've basically become their primary financial institution. That is sticky behavior. That is not a trading app metric, that's a fintech platform metric. But with that said, now let's be honest about what went wrong. Because the market didn't sell off 7% after a risk-off week for no reason. So there's crypto transaction revenue. That's the headline. Robinhood reported $221 million in crypto revenue for Q4, and it's actually down 38% year over year. And for a stock where crypto sentiment has historically moved the needle, that single line was enough to trigger the crypto disappointed narrative across every terminal and every financial X account. But it gets more specific than that. Total crypto notional trading volume was $82 billion. Sounds fine, right? Well, break that down. $48 billion came from Bitstamp. That's the exchange they acquired. Only $34 billion came from the actual Robinhood app. That 34 billion, down 52% year over year. So the acquisition is propping up the total number, but the core retail crypto franchise, the thing that originally made Robinhood a crypto story, is cooling, and that's what equity investors fixate on when they're deciding what growth multiple to assign. And it doesn't stop there. Early 2026 data for January shows crypto notional volume of 22.9 billion total. Robinhood app, specifically 8.7 billion, down 57% year over year. So if you were hoping for an early 2026 crypto bounce on the retail side, these numbers just don't support that narrative. Not yet. Now, why is crypto revenue falling even though management keeps calling crypto strategic? A few things are happening at once. Retail trading intensity dropped. Volatility was lower in Q4, meaning fewer trades, tighter spreads, less monetization per trade. There's also a mixed shift toward institutional volume through Bitstamp, and institutions pay lower effective fees, so you can see volume go up while revenue per dollar of volume goes down. On top of that, Robinhood is competing aggressively on pricing to gain market share. Good for long-term positioning, painful for short-term revenue. Like a cat that brings you a gift from outside. The intention might be strategic, but the immediate result is simply unpleasant at best. So, here's something that flew a bit under the radar. 2026 adjusted operating expenses plus stock-based compensation are guided at 2.6 to 2.725 billion. That's about 18% growth at the midpoint. And management explicitly said more than half of that growth, roughly 10 percentage points, is being poured into new and scaling businesses. We're talking banking, Gold Card, their strategies product, Cortex, social features, Robinhood Ventures, their blockchain project called Chain, tokenized real-world assets. I'm running out of breath. Just know that it's a long list. Now, if you're bullish, you see this as a company investing from a position of strength. They're profitable, they have the cash flow, why not go big? But if you're cautious though, that long list of initiatives reads like a focus risk. Management is essentially asking investors to trust them to execute across 8 or 9 different products simultaneously. And some of those, like prediction markets on equity KPIs, explicitly require regulatory approval that hasn't come yet. When being specifically asked, they also mentioned being in a quiet period for their first private markets offering, with their N2 filing publicly on file with the SEC, which means some of the most exciting potential upside products are in regulatory limbo with uncertain timelines. And then there's this line from management that I think is important and a little underappreciated. They noted Q4 had less volatility and the casual trader stepped away. That's basically management telling you, hey, our results still depend on market conditions. Even with diversification, trading engagement can fluctuate based on the environment. Refreshingly honest, but also a reminder that this business has cyclical DNA. Alright, so let me lay this out simply. The bull case goes something like this. Net deposits stay strong. They keep printing $10 billion+ quarters. Banking and the gold ecosystem build up recurring revenue that's less tied to market cycles. Prediction markets expand beyond sports without regulatory setbacks. The crypto take rate stabilizes as volumes normalize or grow enough to offset lower per unit economics, and operating expense growth stays below revenue growth, so margins either hold or expand. The bear case, crypto revenue keeps disappointing, pricing pressure, lower volatility, unfavorable mix. Interest rates fall, and net interest income, which has been a nice tailwind, starts fading. The new initiatives cost more and take longer than expected, with unclear near-term revenue. Regulatory approvals for key products like KPI prediction markets and tokenized securities keep getting delayed. And credit risk starts creeping in from margin lending or the Gold Card in a risk-off environment. So what should you actually watch? 2 things. If net deposits slow materially and the take rate compresses and expense growth stays elevated, that combination would suggest the weakness is structural. That's the real warning signal. On the flip side, if deposits stay strong, the banking and direct deposit attach rate keeps scaling, management hits their mid-year product milestones, and revenue re-accelerates even modestly, then this sell-off is probably an overreaction. A temporary gap between expectations and reality, not a fundamental crack. Look, I'm not going to tell you what to do with your money. I'm a guy with a cat and a spreadsheet, not a financial advisor. But what I will say is this. A 7 to 8% drop on a headline EPS miss of 3 cents for a company growing revenue 50+% a year with record deposits and expanding margins, that at least deserves a closer look before you panic. Or before you buy the dip, for that matter. The real story here isn't Robinhood missed. The real story is, can they convert a trading app into a financial platform before the market loses patience? The next 2 quarters will tell us a lot. That's it for this one. If you made it this far, genuinely thank you. I know your time is valuable, and the internet has a million things competing for your attention. If this kind of analysis is your thing, subscribe. I'll keep doing these as long as my cat allows me access to the keyboard. Alright, DataCat out, and I'll see you in the next one.